Evolution AB en route to multiple expansion. This analysis outlines the potential returns from investing in Evolution, even under conservative growth assumption. Recent investor sentiment appears overly focused on short-term issues, losing sight of the bigger picture. Quarterly fluctuations and temporary setbacks have led to a fixation on near-term risks, while the long-term prospects remain strong. The current market perception. Due to recent weak quarters, many assume Evolution deserves a low PE multiple between 10 to 15. The reasoning: slow growth, regulatory pressure, anti-ESG stigma, and uncertainty in Europe and uncertainty in Asia. While these factors justify caution in the short term, it's worth remembering that market valuations of entire sectors can shift dramatically over time. Here's a few examples. The defense sector, once viewed as low growth and anti-ESG, now commands higher valuations. The tobacco sector, historically stuck with low multiples, has seen PE expansion for companies like Philip Morris, Altria, and Bats. Healthcare has moved in and out of favor depending on political and regulatory winds. The market sentiment towards sectors changes. There is no permanent law that gambling companies must trade at depressed multiples. Over the long run, stock performance tracks the underlying business. If a company delivers steady growth, strong margins, and high returns on invested capital, the market will eventually reward it with a fair multiple. Tobacco shows this clearly. Despite being disliked, Philip Morris's multiple has doubled due to renewed growth prospects. The same logic can apply to Evolution. Today's low multiple primarily reflects uncertainty about short-term growth, especially due to European regulatory ring-fencing and instability in Asia. Why multiple expansion is possible. Once European regulatory uncertainty eases, Evolution may return to more predictable growth. Even if growth is only 5% per year, the company's scalable model means profits and free cash flow can still rise without constant reinvestment. At a 5% growth rate, a PE multiple of 20 is reasonable, giving a 5% earnings yield plus 5% growth equating to a 10% annual return. This is in line with the market average. Importantly, Evolution is unlikely to stop reinvesting entirely, so actual growth could be higher. But even in a no expansion scenario, its economics would still justify a higher multiple than today's 12 to 14. Remember, the PE multiple is not only a component of growth, but also capital efficiency. This is the most misunderstood, but also the most important thing to understanding investing. It explains why some companies always seems to trade at a high valuation. A company that must retain earnings in order to grow won't have a high valuation. If you are angry for missing seemingly overpriced companies due to a high valuation, perhaps you should study closely why some companies deserves a high multiple. Evolution today trades at a multiple of around 12 to 14 times earnings. This is warranted and not surprising because of great short-term uncertainty. To what extent ring fencing in Europe will affect short-term growth remains to be seen. To what extent cyber attacks and similar problems in Asia will affect short-term growth remains to be seen. It's expected that the market puts a low multiple on current earnings with this uncertainty. However, try to take a bird's eye view and look at the situation in 3 years. Look at the competitive position of Evolution. Do you believe gambling companies will build studios in-house? Do you believe Evolution's margins are unsustainable? If these are your concerns, then Evolution may not make sense for you. But for me, Evolution is widening its moat against competitors. They are establishing themselves as a permanent player in this ecosystem. Many of their direct competitors don't have the will nor the ability to ring-fence their entire European operations in order to establish themselves as a reliable partner which follows the rules and regulations. The gambling operators has time and time again showed that building studios in-house is not economically viable. Evolution captures a great amount of value from the current ecosystem, which likely will increase with more regulation. They don't need to worry about customer acquisitions or KYC. They don't need to spend a lot on marketing. This is done by the gambling companies like DraftKings. The scalability of online gambling makes the high margins of Evolution defensible, even over the long term. These factors will, in my opinion, lead Evolution to be a company that at a minimum will grow with the market. Due to the fantastic financials of the company and the ability to grow without retaining earnings, I foresee a clear path towards multiple expansion in the coming years. Multiple expansion might take years, possibly 5 years, but if the PE multiple doubles over that time, it can add roughly 15% to annual returns, on top of shareholder yield and organic growth. The current 7% yield alone approaches the market's historical return, providing a solid floor for investors unless earnings power collapses. Given insider buying and the company's track record, a total collapse in earnings seems unlikely. Modest growth plus potential multiple expansion presents an attractive risk-reward profile. To conclude, sectors can fall out of favor for years, but the market rarely leaves significant money on the table indefinitely. Evolution's combination of high margins, scalability, and capital efficiency means it does not need explosive growth to merit a higher multiple. If you believe Evolution can grow earnings even modestly over time, there is a clear path to strong returns. The current yield is 7%. You may have modest earnings growth of 5% annually. You may have multiple expansion from 13 times to 20 times over 5 years, giving a 9% annual boost. Estimated 5-year CAGR would be like this: a 7% yield plus 5% growth plus 9% multiple expansion, which is 21% annually. This is before considering any upside from faster than expected growth. If you, like me, foresee a future for Evolution with at least modest growth in earnings, then you should also envision a potential path towards multiple expansion. Don't let current market sentiment affect your understanding of the long-term potential for returns. One of the greatest edges one may have in the market is an extended time frame and emotional stability. Thanks for listening, and this is not financial advice.